Hi, good morning. This is Mayor Valensky with Driving Market Sunday, the 31st of July, your weekly podcast. Let's just catch up on everything that's going on, but looking mainly at US debt. That seems to be the biggest topic of everything these days. Simply put, the US is out of control. Let's delve deeper into this topic and let's see if we can get a clear understanding of what's happening. So, based on reports or based on numbers, by the end of the year, the US has to refinance $6.4 trillion worth of debt, which is coming to maturity between now and the end of 2025. The problem is that they have higher interest rates at the moment, and those higher interest rates would automatically mean that the US has to pay higher interest rates to the holders of those bonds. The problem is that no one wants the bonds. Now, originally or traditionally, you had foreign buyers, which were governments or sovereign funds that would be investing in US Treasuries. So US Treasuries is a bond, also called T-bonds or Treasury notes or T-bills. They have different names, but it's the same thing. So let's call them T-bills for the sake of this particular podcast and explanation. So these T-bills that are normally held or traditionally held by countries like China, Japan, Russia, Saudi Arabia, Middle East countries, and other large sovereign funds have now turned into a selling exercise where those countries do not want to hold those T-bills anymore for a number of reasons. Let's just go into why they don't want to hold those T-bills for a number of reasons. Well, there's been a decline over the years of the desire and the excitement or willingness to invest in Treasury notes. But in February 2022, March 2022, when Joe Biden and his administration froze Russian assets on the back of the Russia-Ukraine war, they essentially froze dollar assets. And those dollar assets were T-bills and currencies held, or US dollars held in bank accounts. That sent a shockwave around the world, around the global financial markets, not because of the war so much as because of the weaponization of the dollar. In other words, what implications would it have that a country or sovereign fund invests in dollar denominated assets like T-bills, and then at a whim they can be frozen by the US? That means that that currency and those assets are not independent of any political movements, and that accelerated the decline in the demand for T-bills from 2022 onwards. But that decline was already happening for a number of years beforehand. Why was there decline in the demand or desire to hold T-bills? Simply put, that the dollar is devaluing. Now, there's an intentional approach to devalue the dollar, or is it by accident? Well, again, the dollar devaluation, if you look over the years since 1971, when Nixon took or decoupled the US dollar from the official gold standard, that was the start of the decline in the US dollar. Why is that? Simply put, that when you have a currency that's backed by gold, then the central bank of that country, in this case the Federal Reserve, could not willy-nilly or freely go and print a load of dollars because they didn't have the gold to back it. However, once you decouple the dollar from the gold standard, then the central bank, the Federal Reserve, is free to print as much money as they want because there's nothing restricting them. In other words, they don't have to have that amount of gold sitting in the New York Federal Reserve or Fort Knox in order to back up the dollar. And what's happened since 1971 has been a escalation in the printing of the dollars, and that has come to a head back in 2008, 2009 at the banking collapse when Lehman's, Bear Stearns, and multiple tens and twenties and hundreds, I would say, of banks globally went bust as a result of the secondary market in subprime mortgage market of the 2008 banking collapse. Now, that printing of the dollars, which was then called quantitative easing, was an exercise to save the banks. So the money was printed and sent off to the banks. And then comes along the COVID debacle of 2020, and there was another trillions of dollars or billions of dollars printed that was shipped out, and that was again diluted the value of the US dollar. And over the period of time through the Biden administration and now through the Trump administration, so we can't just blame Biden, we can also now blame Trump, and whether the Democrats or Republicans have printed a load of dollars and continue printing a load of dollars. In fact, there is an element of stealth printing at the moment, and that stealth printing is whereby it's not officially notified to the markets or the public that they're printing, but the Treasury is printing dollars and piling it into the system. So overall, you have a devaluation of the dollar, and that devaluation of the dollar is going to continue. I reckon we have another probably 25 to 30% fall in the US dollar over the next 4 years. That brings us on to T-bills, which is the government bonds, which are denominated in US dollars. So by definition, if you buy $1 million worth of government bonds today, that $1 million is going to be worth 20 to 30% less in 10 years' time. Is that a good investment? Well, any person with common sense and logic would see that that is a complete and utter waste of time. So the dollar devaluation has pushed investors and traders away from investing in T-bills. Now, furthermore, on top of that, you have now concerns. Does the US have enough money, enough revenue coming in to pay the interest on those T-bills? On top of that, you also have a decline in the appetite of governments around the world to buy T-bills on the fear that their money could be frozen in the event of a political friction between those two said countries. So when you've got now governments and sovereign funds moving away from T-bills, that leaves the private sector, and the private sector is one that you cannot rely on. Why would the private sector invest in T-bills when they're only looking at yield, whereby governments and sovereign funds are looking overall at strategic, tactical, balance of payments, use of the dollar, reserve currency, and other multiple reasons to invest in T-bills? The private investor is only looking at what is that T-bill going to give me in terms of yield. And therefore, in order for the private investor to invest in a T-bill, they will want a higher yield, a higher return, which would force the US government to essentially keep yields at a higher level in order to attract investors. On top of that, with the introduction of the stable coin backed by the US dollar, which means it's backed by a T-bill, what you're going to have is that private companies like Tether, who actually own more T-bills than some governments, are going to end up controlling US debt. And that is not a good thing, because private companies will do what they want and will not be subject to negotiation with a government office. So therefore, how can yields come down if the actual buyers of those T-bills are private individuals? And that is a complicated, complex setup that Donald Trump in his administration has to navigate. One way out of this, which has been suggested by Scott Bissent, the US Treasury Secretary, and Trump, is to invest in Bitcoin and gold on the basis that those are rising assets in terms of value, and at some stage they could be cashed in or revalued in terms of gold to pay off US debt. And if they were to pay off US debt, then obviously that would strengthen the dollar and make US treasuries a lot more attractive. Very interesting setup, but the way we're going at the moment, yields are likely to remain high, and the US dollar is likely to continue its descent, its decline in global financial terms. This is Meir Valensky with Driving Markets. You can download this on any one of your favorite platforms. And if you want to join the mentorship group, you can go to drivingmarkets.com website and sign up there. Have a good day.